Hey, it's Patrick Moore with Ironclad Wealth Management here, and today I've got a video on one of the most basic tax strategies out there to help you save money on the sale of your business, and that's the installment sale. Now, don't tune out yet because I think it is interesting to take the boring approach and see how that actually works versus doing nothing, because I think the outcomes can be surprising. But this is something that I think you'll find to be interesting, and you can kind of see if it makes sense for you to consider. Now, as always, this is general information. It's not specific advice. I hope you learn from it. I hope that it does help you. But if you think it may work for you, remember to take this to your personal tax team and figure out if it actually does make sense for you. Now, what is an installment sale? An installment sale is basically a contract where instead of giving you $10 million, your buyer spreads that payment out over whatever set period of time you agree on 5 years, 10 years, 7 years, whatever that is. So if it's a $10 million sale, instead you get $1 million for 10 years. What happens is, and the reason that this works, is that you pay tax as you get that money. And it reduces your taxes by putting more money into the lower tax brackets, which you'll see how that works in just a moment. So, how does it work? Well, the buyer and seller have to agree to the terms, and as part of the sale, a promissory note will be created to document the payment obligations and secure the debt. Usually, this is going to have a full personal guarantee for buyers because obviously the seller needs to be protected. Because you're basically loaning money to the buyer to buy the business from you, you also get to earn interest on that contract, and that can actually wind up being a very significant amount of money over that installment period. And then finally, you do have to file some additional IRS forms to elect the installment treatment because if you don't, you're still going to owe the full balance of taxes year one. And you don't want to owe the full balance of taxes year one while only getting paid over 10 years. That's not going to be a good situation. So when I say that the installment note is all about timing, here's what I mean. The US tax code is progressive, meaning that the more money you make, the more money you'll pay in taxes. And so by spreading that payment over 10 years instead of 1 year, you keep more money in those bottom layers as you fill it up. And that can result in some meaningful tax savings over time. So if you look at this, these are the capital gains rates here. So from 0 to 96,000, you pay 0% in taxes. From 96 to 600,000, you pay 15%, and then above that you pay 20%. So if you look at that, what that means is the more you spread over time, the more you can do that 96,000, the better off you're going to be. So let's look at the Daniels. So this is a husband and wife. We've worked with them quite a few times here in Georgia. They own an engineering firm. They're looking to sell. They're going to have $9.5 million in capital gains. So I've got two comparisons here. I've got a lump sum sale and a 10-year installment sale with 0% interest. Now, I promise you, nobody on this watching this video should ever do an installment sale with 0% interest. But what I wanted to do is I wanted to illustrate the impact on the capital gains taxes specifically. So if you look at the lump sum sale, well, if you're getting $9.5 million of capital gains, you're going to fill up that 0% bracket. You just are. You're going to fill up that 15% bracket every single year. And then in year one, you'll have about $8.9 million in the highest tax bracket. So by bunching it all in 1 year, you immediately shoot to the top. Contrast that with the 10-year installment sale. Instead of having $96,000, you get 10 years worth of that. You get $967,000 completely tax free. And then you wind up with $5 million in the 15% bracket, which means you have $3.5 million in the 20% bracket, which is $5.5 million less than if you did it all in year one. So it's extremely simple. You're not doing anything crazy. You're not having to go out and do crazy things to try and save money on taxes. You're taking certain risks. You're doing things a little bit differently, but you are benefiting purely from timing, choosing when you're going to pay your taxes. So if we look at this comparison here, you will see that we've basically got everything put together on this graph. We've got the lump sum sale. We've got $7.652 million in proceeds. Act like you don't see that first gold box that wasn't supposed to be there yet. If you do a 0% interest note, you wind up with $8.1 million of proceeds. So you wind up saving about $500,000 in taxes just by using an installment sale. Then, if you look at that, it's 2.3 to 1.824. If you look at the installment sale at 8% interest, you actually wind up, if you think about your giving money or selling to a private buyer, you're going to charge higher than an average interest rate because that's a risky purchase. If you look at that, there you're going to wind up paying about $4 million in taxes, but your net proceeds will be $10.9 million, which is $2.3 million higher than the lump sum sale version. And that's because you're getting that additional interest. So when you look at the installment sale, if everything goes well, you typically wind up in a better position. And the big thing is I ran a little calculation here, a net present value calculation, which is just a financial way for adjusting for the fact that you're not getting that money all year one. That installment sale is worth about $1.2 million more dollars to you today than just doing a lump sum sale. So if it works for you, in a vacuum, what you do is you save money on your capital gains taxes. Now, you wind up making more money and paying more taxes on the interest, but I'd rather make more money and pay more taxes as long as I'm better off at the end of the day, which you are in this scenario. So it's a pretty interesting thing that you're seeing here. Now, unlike some of the other strategies that we've talked about in this series, you don't have to pre-plan for the installment sale. I would recommend modeling it and figuring out if it's going to be right for you, but you don't have to do this 3 years before. This is just part of the purchase agreement, and you're agreeing to take back $10 million over, 10 years instead of getting $10 million up front. Another thing you have to do is you have to use market interest rates. If you don't, the lower interest rate is considered a gift to the buyer, which can cause some tax complexities, but it's something you need to be aware of, and you must file that Form 6252. And certain assets are not eligible for the installment treatment. Now, what can go wrong? The biggest risk is very simple. What if your buyer can't pay you? If your buyer can't pay you and you've taken an installment sale, you will have to repossess the business, hope it's still in operating condition, and try and bring it back up to speed and get it running again. That's your biggest risk. A lot of times these agreements will have personal guarantees in there, but oftentimes the buyer's assets aren't going to be fully enough to cover that full balance. So it's something you need to be aware of and evaluate the possibilities. Your higher income may offset tax savings, meaning if you have other sources of income, if we look at that little comparison grid, it was filling stuff up from the base. If you're going to have $500,000-$600,000 of income from other sources when you do sell the business, well, there's not going to be any tax savings there because you're not getting the benefit of those lower brackets. Other thing is, if you defer more than $5 million in gains, you will have some additional interest penalties from the 453A penalties. And they're not all assets qualify. Things like inventory, accounts receivable, asset depreciation recapture, those cannot be deferred, and you'll owe them all in year one if you sell the business. And then there's limited flexibility if your needs change once you sell the business. Having said all of that, who are installment sales best for? They are best for people that you trust who don't have the upfront cash. Buyers that you know and with an absolutely kind of unbiased eye believe they can make the business run and work. The second is for sellers who are expecting lower post-sale income. Let's say you don't have much in other assets and you're going to really have really minimal income outside of your investment accounts in this installment note once you sell. It's a good thing. It's a good thing to look at from a tax perspective. And then finally, you got to be able to afford the delayed payments. You can't have plans for all $5 million you're going to make because you're not going to get it all at once. So it's something that is a definite benefit that can work in the right situation. So how do we help? Well, we help model your sale for various tax impacts, and we look at multiple different strategies, not just the installment sale. We collaborate with your legal team, your CPA. We help you structure the deal the right way. And really, our job is to make sure that we advocate on your behalf. We don't care if you do an installment sale or not. It's just, what do the numbers look like here? What do the numbers look like there? Which one works for you and which one actually makes your life better once you sell the business? So before you sign your LOI, set up a call with us if you'd like, or hey, if you've already had an advisor, go talk to your advisor and make sure that you know what the next 10 years of your life are going to look like once you make this decision. So I hope that this kind of gave you some flavor for what I consider to be a very basic planning idea, something that I think everybody takes for granted, but it's really, really good to understand and see if it works for you. Hope you have a good rest of the day. Talk soon.